Russ, what is the simple signal of the bond market Mr. Farrow describes? The idea of yields lower, obviously lower for longer, but the negative yields really pegged down near their biggest negative yields.
Well, thanks, Tom. You know, the negative yields we're seeing primarily the same place we've been seeing them for much of the last decade in Europe and Japan. I think that reflects a couple things. One, more muted growth prospects in those economies, and in particular central banks that we believe, and I think most investors believe, are going to lean into easy money negative rates for a very long period of time, and that negative policy rate is pinning down the long end of the curve in those markets as well.
Russ, the tolerance for higher interest rates, given how much we've just added to debt worldwide, arguably that's diminished a heap over the last 6 months, Russ. Just how self-limiting would any potential Treasury sell-off be?
I think that's a really important point, and I do think it would be self-limiting for a couple of reasons. One, the central banks are not agnostic to what's happening on the long end of the curve. You've got open-ended QE. You have the ability to talk about the length of the policy rate being where it is, so-called forward guidance. And the simple reality is, even apart from the central bank's reaction function, we still have an economy, not just in the U.S., but globally, that's struggling to get back on its feet. Unemployment is elevated. There's been a lot of demand destruction. So while I do think rates can tick higher, and certainly if there's a Democratic sweep, that's probably the near-term path of least resistance, it's just not obvious that rates are going to melt up given the economic situation and given what central banks have very clearly communicated throughout the world.